Now, let's go ahead and pick up on more international trade issues in the 19.2 subsection of Chapter 19. When we left off last time, we were talking about production and consumption with trade in an open economy, right? So let's go back and remind ourselves and refresh ourselves on this particular issue. So if we have an open economy with international trade, we will find out that through the process of the market, resources are redirected to produce goods in which people have a comparative advantage, or nations have a comparative advantage. And this happens naturally, just like the fact that, using a personal example, someone who's good at math would be attracted to the accounting profession, and someone who's really, really good at handling people would be attracted to professional sales. That happens naturally because you tend to gravitate to things that you have advantages in, right? So we've already proven that more can be produced at a lower cost when, in the example we used, the US specializes in wheat and bread production, and France specializes in grape and wine production, because both of them have a comparative advantage in that area. And what did we mean, again, by comparative advantage? In the US, growing wheat was cheap in the sense that to increase wheat production, you only have to give up a little bit of wine production, where in France, to grow more wheat, you have to give up a lot of wine production. Therefore, wheat's expensive in France and it's cheap in the United States, as measured by opportunity costs or the other things that you have to sacrifice to increase the production of one of the goods. So if both countries are now specializing in their area of comparative advantage, then both countries are maximizing their total productivity, and then they trade their surpluses with each other, and the US ends up, through its extra production of wheat, keeps some of the extra wheat for itself, increasing its wheat production, trades some of the excess wheat production now that it's doing so, and buys the wine that it's no longer producing, and then France does the exact opposite. It's cut back on wheat production, but it's increased its wine production, so it sells some of its excess wine production, and with that excess wine production that it sold, it buys the wheat it's no longer producing, and both countries now are consuming both more wheat and more wine than they could produce on their own. So that's what we mean by mutual gains. Both countries to a trade benefit. It's not one country taking advantage of another country. Both countries benefit, and therefore both countries' standard of living rises, which is why most economists are very happy about international trade and generally ask societies to reduce their trade barriers. Now let's talk about the pursuit of comparative advantage. Remember, we talked about the comparative advantage is the ability to produce a good at a lower opportunity cost than others. And we used the wine and wheat production as our example. But of course, we could have used lots of other examples as well. So it's pretty obvious that firms produce and export the goods and services for which they have a low opportunity cost, because those will be the ones that you will be more competitive in, right? And firms buy and import goods and services that, if they produce them themselves, would have a high opportunity cost. So trade is not based on the absolute advantage in production, rather it's based on the comparative advantage. In other words, what your opportunity costs are. You produce the things that you have a low opportunity cost in. Now let's talk about terms of trade. The terms of trade are the rate at which goods are exchanged in the market. So this is not a production issue, this is now a trade issue. So the amount of good A that you have to give up to your international trading partner to get good B is your terms of trade. It should be pretty obvious that a country won't trade unless the terms of trade are better than simply making the goods at home. Because remember, in our example, both the United States and France can both produce both wheat and wine. For the United States to decide to import wine from France, it must be a better deal to buy the wine from France than simply making it in the United States, and vice versa. If France is now going to start importing its wheat to make bread, it has to get a better deal from buying it from America than simply producing itself, otherwise it won't bother importing it from the United States. At least not in a world of free trade. Now, obviously, under the old days of gunboat diplomacy and colonialism, where you force the other country to sell to you, well, of course, there's no reason to believe that those prices will benefit both sides. But in free international trade, it has to benefit both sides. Otherwise, you would simply refuse to trade and you would grow the stuff yourself. Okay? So the fact that people voluntarily trade with each other shows that, in fact, we are buying from the low opportunity cost producer. So as long as the terms of trade are somewhere between their own opportunity costs at home, then countries have a reason to trade with each other. So let's go through an example. Country X produces one car at an opportunity cost of 200 bushels of wheat and vice versa. So that means, then let's take a look at country Y. Country Y produces one car at an opportunity cost of 100 bushels of wheat and vice versa. So it turns out that country Y obviously must be pretty good at producing cars, because you don't have to give up much wheat to get a car. So country Y has the low opportunity cost of cars. So what does country X have? It must have the low opportunity cost of producing wheat, because obviously if you run the numbers in the other direction, producing wheat is cheap in country X because you give up very few units of cars to produce the wheat. So country X can produce the wheat more cheaply than country Y. Country Y can produce cars more cheaply than country X. So X should produce wheat and Y should produce cars and then trade their surpluses. That's the whole argument for international trade. So an agreeable trade will occur somewhere between one car for 100 bushels of wheat and one car for 200 bushels of wheat, because one for 100 is Y's opportunity cost and one for 200 is X's opportunity cost. Let's assume that they agree to 150 bushels of wheat equals one car. That's the deal that they're going to make. Does everyone recognize that both countries will end up being better off? Because for country, country X, when they're producing one car for 100 bushels, they can instead export the car and collect 150 bushels from the foreigners, and vice versa. The foreigners that would normally have to spend 200 bushels of wheat to produce their own car can simply import the wheat for 150 bushels, and therefore they would have both more wheat and more cars. So that's again the takeaway. We're simply repeating ourselves, just different angles on the argument that voluntary international trade, where both parties voluntarily agree to enter into the deal must make both parties better off. Otherwise, no one would enter into the trade. So voluntary international trade benefits both parties. Now, how do markets and prices enter into this? Because we've been talking so far about just wheat and wine, or cars and wheat, or physical items one traded for another. But the reality is most of us trade for dollars or French franc, well, euros now, European euros or Japanese yens or Mexican pesos. We do our deals in currencies. So how do currencies enter into this argument? That's what we're going to talk about here. So how does markets and prices enter into it? So let's make up another example. Now we're going to be doing French wine for American laptop computers. That's going to be the two trades. So Henri from France, he's in the wine business. Now we've already established that he has an opportunity cost in wine. He gives up very few resources in order to produce wine because France happens to be naturally good at doing that. So we now find that when Henri sells his wine to the United States, he has a cost advantage in it and is able to take market share in the United States. So as we see in our bullet points, the US consumers buy the French wine and they cut back on US wine. So automatically the market starts to shift the production in the United States away from producing wine. But on the flip side, Joe from the United States is really good at producing computers in Silicon Valley, and he ships laptops to France. Why? Because his cost of producing laptops is cheaper than the French cost of producing laptops, because laptops have a high opportunity cost in France. So the fact that he's able to sell the American laptop in France shows that he has a comparative advantage in that. And so Joe now is selling laptops to France. The French buy the laptops and by definition cut back on buying their own country's laptops. So the market automatically starts causing France to have an increase in their wine industry and a cutback in France's computer industry, and vice versa. In the United States, we have a cutback in the American wine industry and we have a growth in the American computer industry. And that will happen automatically, not by someone talking about comparative advantage, but just having business people buying and selling from each other will naturally cause that to happen. So what happened to the U.S. production? I'll go through this very quickly since we kind of covered that. The U.S. consumers automatically cut back on the U.S. wine, causing U.S. winemakers to lose sales, cut back on production, and lay off some wine workers in the U.S. French buyers will cut back, of course, on buying French laptops to buy the American laptop, so French laptop makers lose sales, cut back on production, and lay off French computer workers. So who's happy and who's unhappy out of this deal? Well, obviously in the United States, laptop manufacturers are happy because they're adding sales, and their workers are happy because they have more jobs. So we obviously see somebody in the U.S. is happy from this. But of course, in France, the wine growers, they're also happy because the wine growers are expanding their sales, and the workers who work for the wine growers are happy because they have more jobs. So those are the happy people. Who are the unhappy people? Well, in the U.S., what do you think wine growers think of all this French competition? They're not happy because obviously their sales are going down, and of course they have to lay off some of their workers. And in France, the exact opposite's happening. The French laptop manufacturers have to cut back on their sales because they can't compete, and their workers are unhappy because they're being laid off. It's going to turn out something that you should recognize very quickly. Those who are unhappy, the U.S. wine growers and the French laptop manufacturers, are going to go to their respective government officials and complain about trade. So even though economists can prove that for the country as a whole, this is a good thing, obviously the specific industries that are harmed by the trade are not going to be happy about all this, and they're going to complain to their government officials. And that's what leads to trade barriers. Even though economists since the time of Adam Smith, we're talking over 200 years ago, we were able to prove that trade makes both countries better off. It's a good thing that the U.S. is cutting back on wine production to free up the resources to increase the computer production. And it's a good thing for France to cut back on computer production because obviously they're not very good at it. Instead, they should use their people where their people are productive, and they should increase their wine production. The total income of France will rise if they cut back on computer production, which sounds counterintuitive. Most of us think, oh no, you got to produce more computers. Well, only if you have an advantage at that. That would be like telling someone who's not good at math, oh, you should go into accounting because accountants get paid a lot. That's a stupid argument, isn't it? You don't want to tell someone who doesn't like math, who's never going to be good at math, to go into accounting. They will never be productive at accounting. It makes more sense to do something that they're good at, like handling people and therefore going into sales. They will be successful there. The same thing is true for countries. In the example, and again, we just made up the numbers. I don't know what the true advantages are, but we do know that France doesn't export very many computers. Can you name a single French brand of computers? No, they're not very good at it. Whereas the Americans are, the Japanese are, Sony computers, Toshiba computer, there are several Japanese brands, Samsung in Korea, the Koreans are really good at it, but the French are not, for a whole bunch of reasons. So for France to spend time wasted on computer production when they take workers away from industries that they're really good at, like wine production, makes no sense whatsoever. The French should specialize in wine, cut back on computers. The Americans should cut back on wine and increase computers. And both countries will have a higher standard of living after the workers in the loser industries move to the industries that they really are competitive in. And that is the key. But unfortunately, of course, this generates a lot of political pressure to stop the trade because the folks who are already in the American wine industry don't want to convert over to computers, and the folks in the computer industry in France don't want to convert over to wine because they're already invested in those industries, right? But ultimately, for the benefit of society, this really does need to happen. So that's our final takeaway on this particular issue.